Melody Mania, Anatomy of a Market Mistake. Welcome back to The Explainer. Let's just get right into it. Today, we're looking at a completely fascinating intersection of viral internet culture and the, very serious world of the stock market. We usually like to think of the stock exchange as this completely rational machine driven by deep financial analysis. But honestly, sometimes human behavior just takes the wheel and the results are, well, they're bizarre. Today, we are dissecting a market event that proves just how wild things can get when social media hype collides with retail investing. Let's break down the anatomy of a market mistake.
Okay, let's dive into this. How exactly did a viral social media meme about a literal, everyday chocolate, Toffee, accidentally pump massive amounts of trading volume and money into the totally wrong company? I mean, it sounds like a financial comedy sketch, right? But this actually played out on Dalal Street. To really understand the psychology of retail trading, momentum investing, and just the sheer raw power of internet attention, we are going to use this incredible real-world case study. It's a crazy story of mistaken identity, herd mentality, and a rally that left market watchers completely scratching their heads.
Let's look at the timeline. Tuesday, PM Modi gifts a Melody Toffee. Wednesday, PM Maloney posts a viral thank you reel. Thursday, a completely unrelated stock rockets up on Dalal Street. It is honestly wild how fast this played out. It all kicks off on a Tuesday, simply as a sweet diplomatic gesture from Prime Minister Narendra Modi to Italian Prime Minister Giorgia Meloni. Wednesday rolls around, and she posts a quick reel online thanking him, dropping that famous Melody reference. Well, the internet absolutely loses its mind. The reel goes massively viral. By Thursday, retail investors, totally eager to capitalize on this internet moment, end up sending a completely unrelated stock straight into orbit. 3 days. That is literally all it took to go from a simple box of chocolates to an absolute stock market frenzy.
The result of that 3-day madness? A near 5% surge, pushing the stock up to 5 rupees and 51 paise. Now look, a 5% jump might not sound like a world-altering number, but context is everything here. This penny stock jumped for literally 0 fundamental reasons. There were no major corporate orders announced, no surprise earnings reports, nothing at all about business expansion or new management. Seeing a stock surge like that on absolutely no news is a massive red flag. It was driven purely by a viral reel, a familiar brand name, and an absolute flood of retail attention.
Now, what's really interesting about this slide is the almost comical case of mistaken identity it reveals. On the left side, we have Parle Products. They are the actual real-world manufacturers of the iconic Melody Toffee. But here's the catch. They are an unlisted private company. You literally cannot buy their shares on the open market. And then on the right side, there's Parle Industries. This is a listed public company that anyone can easily buy shares in. The problem? Parle Industries has absolutely zero connection to Melody Toffees, none whatsoever. But retail investors were so desperate to jump in on the viral hype, they just searched the name, landed on the wrong ticker, and hit buy anyway.
The frenzy continued, fueled by a familiar name and social media attention. Proving attention can become an asset itself. And honestly, this is where the story shifts from being just a funny little internet mishap to a super serious market phenomenon. Because even after it became widely reported that this was a massive case of mistaken identity, the frenzy didn't stop. The stock just kept rallying. Why? Well, because in today's hyper-digital trading environment, the actual core business can sometimes become secondary to the hype. When a penny stock catches the internet's eye, attention practically becomes its own asset class. People weren't trading on the value of toffees anymore, they were trading on the sheer volume of eyeballs and clicks happening on social media.
To really understand the gravity of this, let's bring in an expert. Abhishek Villawaria, an AMFI-registered mutual fund distributor, points out that this specific rally is a textbook example of herd mentality overpowering logic. And he hits the nail right on the head. Investors weren't pulling up balance sheets or reading quarterly reports, they were just blindly following the crowd. It highlights this critical, really dangerous aspect of retail investing today. When social media algorithms amplify a story, traders rush in, market operators join the wave, and suddenly all financial logic is completely thrown out the window. Doing your own proper research is basically your only shield against this kind of herd behavior.
Let's move to and see how this builds, because we need to break down the actual mechanics of what market watchers call the momentum trading lip. It happens in 4 super predictable steps. First, traders spot a stock going viral, even if it's for totally the wrong reasons. Second, because they start buying in, trading volumes are artificially pushed much higher. Third, this rising volume acts like a giant flashing neon sign and new buyers just jump in hoping the price is going to keep going up. And finally, step 4, the early buyers, the ones who started the whole wave, quietly exit their positions and pocket their profits. This entire loop feeds on itself, completely disconnected from what the company actually does.
Which brings us to a foundational concept in market psychology. It's the engine behind almost all of these meme stock frenzies, and it's called the greater fool theory. This is when you enter a trade simply hoping someone else will buy it at a higher price later, regardless of the asset's underlying fundamentals. I mean, think about it. As this rally went on, plenty of people buying those Parle Industries shares absolutely knew it was the wrong company, but they bought it anyway. Why? Because they were gambling that a greater fool would come along later and buy it from them at an even higher price. They aren't investing in a company's future, they're just playing a massive game of hot potato, hoping they won't be the last one holding it when the music finally stops.
So the crucial point is exactly what Bill Wario warns us about here. He says, fundamentals don't support the move. Liquidity can dry up quickly, and lower circuits can come just as fast as upper circuits. This game of musical chairs is insanely dangerous for everyday investors. When you buy into a rally that isn't supported by an actual business, the fall can be brutal. Liquidity, meaning your ability to actually find a buyer when you're ready to sell, can just vanish in an instant. Upward surges are fun, but lower circuits hit just as fast, plummeting your investment while literally no one is willing to buy your shares. The late entrants, the ones swept up at the peak of the hype, are always the ones left holding the bag.
So how do you actually protect yourself from falling into a trap like this? The takeaways from this explainer are pretty straightforward, but they are absolutely essential. First up, always verify the actual underlying business before investing. Take 5 minutes to confirm you are looking at the right company. Second, do not blindly follow social media trends as financial advice. A viral reel is not a prospectus, guys. And finally, ignore ticker name hype. Just because a stock's name sounds exactly like a trending topic online does not mean it holds any actual real-world value. Investing has to be based on logic, not likes.
Which leaves us with this final, lingering thought. Melody is still playing on Wall Street, but do investors actually know the lyrics? This whole bizarre sequence of events serves as a massive wake-up call. It shows us exactly how quickly internet attention, momentum, and sheer human emotion can just completely override fundamental financial sense. So the next time you see a stock skyrocketing because of a viral trend, you have to stop and ask yourself, are you actually making an intelligent investment? Or are you just getting swept up in the mania? Thank you so much for joining me for this explainer. Keep questioning the trends, always do your research, and I'll catch you next time.